What is a security? So a security is formed when you as the investor are taking a passive investment approach. You like, hey, I don't want to actually fix, a toilet. I don't actually want to even look at a real estate deal, but I do want to invest in real estate. I want all of the benefits. It's security. You're coming in passively. Hello, everyone. Welcome back to episode 1. That's Real Estate Roundtable with MRTG Capital. My name is Tom Goodge. I'm here, as always, with my friend and business partner, Mike Rohm. So today we're going to dive into 2 essential topics that any potential real estate investor should know.
Yeah, absolutely, Tom. So SEC Regulation D, Rule 506B, and Rule 506C is what we're going to be talking about.
Awesome. Good deal. So let's get into it. So first things first, like when we talk about the Securities and Exchange Commission, I think let's first talk about, the first word in their name in Securities Exchange Commission, right? Securities. What is a security? I think a lot of people can't really answer what a security is. So everything that we want to talk about on this podcast, we want to just make it very simplistic for you, because you can't make a good decision if you just don't understand the foundational stuff, right? And if something's scary and if someone's trying to confuse you, you're not going to be able to make a good decision. So a security, what is it? Quite simply, when you hear a security, what the Securities and Exchange Commission, what they're really defining that as in the simplest terms is that whether it's a stock, right, a bond, a mutual fund, or in our case, real estate, somebody, in this case, let's say MRTG Capital, they went out there, they've done the work. And in our situation, we went out there, we found a real estate deal. We went through thousands of deals. We found the best one, that we feel will be, will fit our investor needs. We've done all the work. We've done all the legwork. We have it under contract. And then you as the investor are reviewing a deal in order to make a profit passively. And so a security is formed when you as the investor are taking a passive investment approach to a deal that someone else is saying, hey, trust in me, and let's say a stock as an example, right? Hey, I have this company, I'm publicly registered, and I'm coming in here and saying, hey, our company's doing great things. Do you want to invest in us? You're not actively in the company, but you were investing passively. That's a security. You're intending to make a profit off of someone else's work. And then real estate, quite simply, is you like, hey, I don't want to actually fix, a toilet. I don't actually want to even look at a real estate deal, but I do want to invest in real estate. I want all of the benefits. It's security. You're coming in passively. So that, just to make that very clear. But then secondly, what we talk about SEC, and you said Regulation D, the Securities and Exchange Commission out there, they obviously are there to, as a body to make sure that investors have a safe place to invest, right? Like Absolutely. You as an investor coming in and know that, hey, someone is actually having to adhere to rules. And Regulation D isn't something that's scary. All that quite simply means is that's out there for us real estate investors so that we can actually not have to have a formal registration for our deals. So it's not like we're registering on the stock exchange. We have a deal that is adhering to rules and then still having to submit to the SEC, but it's not a registered deal. That's all Regulation D is. And it has 2 rules underneath of it, rules 506B and 506C. So let's start there. How about for 506B, that rule under Regulation D? Let everyone know what that's all about.
Yeah, absolutely. So Rule 506B, it allows us to raise unlimited funds, but it comes with certain restrictions with that. So we can have unlimited accredited investors and max up to 35 sophisticated investors.
Okay, actually, just so right there, just I want to stop you there. So just like, I've thought about security, right, and defining that, for everyone here. Walk us through what an accredited investor is and what a sophisticated investor is.
Yeah, absolutely. So an accredited investor is an individual who makes $200,000 or more a year over the last several years, or a married couple filing jointly, however you do it, making $300,000 a year for the last couple of years. Or they have a net worth of $1 million or more, not including their personal residence. So a couple of those things go into play there. Again, $200,000 a year or more by yourself, $300,000 together, or $1 million in asset, excluding your personal residence. So a couple different items to make you an accredited investor.
So, okay. So you just told me, so for Rule 506B, that's under that Regulation D, you said that we can have an unlimited number of accredited investors for a deal, that we bring, and then 35 sophisticated investors. So why would we want to do a Rule 506B?
So 506B, I mean, they call that the friends and family deal. So you have a network of people who you've had relationships with previously, and I do want to touch on the sophisticated portion.
Sure.
Of what a sophisticated investor is. It's somebody who has previous dealings with either business or investing in the past. So it doesn't mean you've technically ran businesses. You could have invested passively. So it's just how the SEC determines what a sophisticated investor has had previous experience.
So you know what you're doing. You can like evaluate a deal, right? It's pretty much what they're looking for.
Exactly. And same thing with an accredited investor. They want to make sure that you have a net worth that you know how to manage money. And this is how they're regulating that. So same thing with the sophisticated investor. You might not have the accreditations of an accredited investor, but it gives you that you have the background of investing. So SEC is looking out for the investors.
Awesome. That makes sense.
So so that was the 506B portion with the accredited investors and sophisticated.
And so, I mean, if I'm like an investor, and once again, I'm just trying to think from an outside perspective in, right? Like, so you're coming at, from a Rule 506B, why would you have a deal that you're presenting, and why would you have that under Rule 506B, or why would you adhere to those rules for the SEC? Like, what's the benefit for a 506B for us?
So that's where it opens up to people who, they say an accredited investor on a 506B, there's not a verification process for the accredited investor. So it kind of allows for the investors loosely to have that credentials compared to a 506C, which we'll get into that in a minute.
Okay, sure.
But so it does allow other individuals to be able to invest into these deals compared to a 506C. Again, I know with a 506B, we cannot advertise these deals. We cannot just start calling people and telling them about these deals. We have to have prior relationships with each individual previously. So we have to talk about your investment goals. Would this be a right fit for you compared to, just calling and asking for investment? So it has to be prior conversations about investing, figure out your goals, make sure they align with yours along with ours, what we invest in, what these deals are, because they are going to be multifamily, multifamily housing and different type of investments that they will be. So just got to make sure they align and have those outlined and documented for the SEC previous to spreading the deal. So again, we can't just advertise it, throw it out online and put it out there.
Okay. No, that makes sense. And I could appreciate, right? I mean, at the end of the day, not everybody, meets the rules from an accreditation perspective, but they're like, hey, I have the money to invest, right? And I have invested before, stocks, real estate, or what have you. And that's where that flexibility is at. So that makes perfect sense. And I guess, just one thing we'd want to even say there is, like, for Rule 506B, the biggest thing is, and why to reach out, to us or another syndicator ahead of time, is that once we have a deal under contract, the Rolodex gets frozen at that point in time. So we can't advertise it, and we can't rush to get new people under as well. So we have to have those meetings ahead of time for sure. So awesome. So that's 506B. What about 506C then?
Yeah. So 506C is for accredited investors only. Those are vetted by the SEC. So they ask for the credentials. They ask for documentation of the income of your assets and everything along those lines. So that is a more scrutinized investment that we are able to advertise directly to. If we wanted to ask online, however we wanted to advertise, we could just put that out there. So that is somewhat of the difference.
Nice. And and I guess just to shuck that down to the cob, quite simply, like, we're going to have deals that, our network, right, may be completely tied up in other deals that we're doing. We're helping make money for them there. And some of these deals are going to be larger, that'll require multiple millions of dollars to raise. And that's where we have to go to a larger pool of investors, advertise it. So awesome.
And that's where kind of the 506B, like we said, you can only have 35 unaccredited investors. So it's a smaller pool, probably a smaller type of investments compared to like you said, 506C. That pool can be unlimited amount of people with a large range. So those will be most likely a lot bigger investments.
Awesome. Okay. Well, good deal. And so, yeah, I mean, that pretty much in a nutshell, like allows you to hear about, okay, when we talk about, because these are things that you're going to hear and you're like, okay, what are they talking about?
Mm-hmm.
So what's the security? We hit on that. Regulation D, and what's under Regulation D? Quite simply, once again, Regulation D was we're not, being required to register it. And 506B and 506C is just how we're able to advertise or not and who can be involved. And the other thing that we wanted to hit on today, and this is something that once again you may not know as a potential investor, and you should, is the vehicle of the self-directed IRA. The self-directed IRA, just quite simply, and this is something that in future podcasts we will interview lots of different people who have offerings for self-directed IRAs. But you may have a 401k that's out there, right? That's from another company or things of that nature. But quite simply, there are many people out there in America today that could say, like, listen, I don't have an extra $50,000 or $100,000 that I can invest in real estate. I would love to, but it doesn't mean I don't want to still try to build my net worth, right? I want to have an awesome retirement. I want to see how I can continue to do that. You may have an old 401k that's out there, an old, old IRA or what have you, that was from a previous company. You have some money in there. It's in a mutual fund or insert what have you. And you're like, hey, I never did anything with it. I never rolled it over. That will be eligible. Or if you're self-employed as well, right? You may just have your own, IRAs or 401ks yourself right now as well. And you can roll that into what's called a self-directed IRA. And that self-directed IRA quite simply allows you to invest in alternate, you can invest in other things outside of real estate as well, but it gives you flexibility into what you invest in. And it's a whole conversation in of itself on, the companies out there that you could roll over into a self-directed IRA, but it's one also that shouldn't be foreign to you. You as an investor, right? You as a person who is looking to build wealth needs to know that exists out there. So yeah, what we'll do, we'll just for future episodes, we'll interview different companies that can give you more information on that. We don't have skin in the game one way or the other on what the company is, but that is something that you could leverage a self-directed IRA into investing with us as an example.
And part of that, I think you mentioned it. So in your 401k, if you invest into the mutual funds, stock market, you don't really get to pick where you put your investments. You get to put it in that one pool of investments, and that's it. So self-directed IRA would allow you to invest into real estate. So it's another way of diversifying your money and your investments. So I know some people sometimes get worried about the stock market. There you go. So it's just another way for you to diversify your own investments on your own, and you to have a hand in it. So
100% for sure. So we'll continue, like, once again, like everything that we provide to you or anyone that we interview, we want them to have value so that something, once again, is one, it, right? Because you don't know what you don't know. Right. And then we want to be that, that company, that those people for you that help you there, then also make it so that it's very simple, plain and simple. And this is something as well that doesn't need to be complicated. We want to simplify that for you. So with that being said, we'll, also too, we'll keep things crisp as much as possible. There will be times we can banter back and forth, but for this, we'll keep it crisp. And thank you for hanging with us today. And we'll have another episode for you, quick, fast, and in a hurry.
All right. Awesome. And absolutely remember, investing is a journey. So let MRTG Capital be your guide. See you guys in the next episode. Thank you.
Thank you. If you would like to connect, please head on over to mrtgcapital.com and request time to meet with us to answer any questions you may have about real estate investing through a syndication. We partner with small groups of investors just like you, and we're always reviewing deals that could be of interest to you.